is the value trade over before it really even got any legs? And I think, for about 6 months leading into the last video, that was what the topic of these webcasts were, is that leadership was changing. I think it was obvious to anyone participating in the market that the popular tech names were starting to sort of run out of gas, and we were getting some performance out of sectors that had been sort of left for dead. Energy, industrials, healthcare, some of these things were starting to rally and really kind of hold the market higher. So the market was up year to date, despite the fact that tech was no longer leading. And that's what we were talking about coming into the last video, which was also the war or the conflict in Iran was a little bit fresh at that point. And what's happened since then is the exact opposite. So leadership has changed right back to tech. And anything non-tech has not necessarily been crashing or down, but languishing, certainly relative to tech. It's a little bit hard to understand other than the narrative has shifted almost immediately. The Strait of Hormuz being closed and the potential damage that it's doing to energy markets and other commodity markets. It's almost like the market or market participants, at least short-term market participants, want to ignore that, and they're looking for a new narrative. And that new narrative is that the AI revolution is here, and it's irrelevant what else is going on in the global economy. Money is pouring in, and there's an infinite supply of it in order to support new data center build-outs and this circular financing going on for new chip demand when there's a chip shortage. And it's a little hard to justify, but that is reality. The tech and semiconductors in particular are absolutely on fire the last month. Last webcast video, we talked about the possibility of rate hikes, which was simply, it wasn't part of the discourse in the financial world. People were talking about rate cuts, and that's going to be the whole benefit of replacing Powell with Warsh, and we're going to have lower interest rates, and that's going to be helpful for housing and for equities and just growth in general. And I just think there's a lot more to the story than that, and that's where, in my opinion, the whole situation in the Middle East really becomes relevant. We've seen oil rally quite a bit since the start of the war, not nearly as much as a lot of oil experts thought it would, or maybe still think it will. And the reason that that's relevant is because the shortages that are potentially coming, not just in energy markets, but also in other commodities. There's a lot of food-related and agriculture products that need to get delivered through the Strait of Hormuz, and that's all being blocked as well. So all of that is inflationary, and we're not seeing it yet in the numbers. But if and when inflation starts to pick up as a result of this, and we are like you said, we're starting to see Treasury yields perk up a little bit. The narrative is sort of shifting, or at least I think it should be, because inflation and the subsequent rate hikes that happened in 2021, 2022 is what derailed the tech trade back then. And nobody was looking for that to happen. We were seeing enormous, the Mag 7, everything was up 50, 60, 70% in 2021. And there was nothing that was being seen as potentially getting in the way. And then all of a sudden, inflation perked up, and the Fed had to raise rates, and they did so fairly aggressively. And all of a sudden, all the air came out of the tech bubble or tech trade. And I'm not suggesting that is definitely what's going to happen this time around, but I do think that people are just ignoring this fairly obvious risk. Am I worried about what's happening to not just domestic, but global crude oil inventories? I don't want to bore our audience, but am I nervous about it? Yes. So basically, everybody knows that there's an issue with the Strait of Hormuz being closed, and that there's some production of oil and natural gas and related commodities that has been disrupted. The issue is that it's kind of being papered over with with withdrawals from inventories. You know, we've got stockpiles. The Strategic Petroleum Reserve has hundreds of millions of barrels of oil, and we're drawing on it fairly aggressively in order to make up for this daily shortage that the global oil markets currently enduring, and that's happening worldwide as well. So the reason that I'm worried about it is because these inventories are seen by the market as sort of a stabilizing force, and it's a reason why, the mismatch between oil supply and demand will never get that out of whack because we've always got these inventories. That's the fact that we are 2 weeks away from lowest inventories in the United States since 1983 seems like it should be a very big deal because there's no longer this buffer that exists, and that would be okay if oil prices were lower. But the second part of the question is, can't we just fill it back up? The answer, of course, is yes, in theory we can. It's just much more expensive to do that now with oil at $100 a barrel than when it was 50 or 60. So it's hard for me to comprehend how we aren't talking about this as being a potential major issue. It's sort of like the debt ceiling debate that happens every year or so. You know, how is this not something that we're working on? I don't know what the solution is. You know, there's not an immediate solution because a resolution to the war or the conflict doesn't actually fix this overnight. I know there's something in the news about, we're taking oil out of Venezuela to make up for this. No, we're not. We're not. That's not actually happening. So I am worried that this is all going to cause a second wave of inflation, and that the Fed is going to have no choice, whether Warsh is in or not, the Fed's going to have no choice but to hike rates to choke off inflation, and it's going to potentially cause a decline in growth and a decline in markets. This sort of goes back to, I think we did a video at some point last year where I made the reference that there should be something in your portfolio at all times that you hate. You know, there should be also something that you love, something that's working at that point in time. But bonds have been something that I don't know if you hate it. I mean, they're not volatile, but yeah, it's true. They've gone nowhere for the last 5 years. Of course, you're getting interest payments, so you're getting something out of the deal, and you're also getting muted volatility across your portfolio where stocks don't always go up, you know, regardless of what's happened the last 30 days. So I think the question is there still a place in the portfolio for bonds? And I think we've answered that exact question once a year for the last 5 years because we've been in an epic bull market for equities. Yes, it's been very frustrating. You know, as interest rates have risen, you know, the middle of the curve and the end of the curve, you know, the longer dated treasuries have gone up in value, which puts downward pressure on bond prices. Should we enter another Fed hiking cycle? So going back to the previous question, if inflation does start roaring its head again and the Fed is forced to hike rates again, what happens to bonds? There's the theoretical possibility that a Fed hiking cycle would be bearish for stocks and bullish for bonds, which maybe doesn't make sense, you know, at first blush because rising interest rates are supposed to be bad for bonds. But what we've seen in the last 5 years is that the yield curve has gone from deeply inverted to a little steeper. It's not steep by any means, but it's steeper than it's been. And if the Fed were to hike short-term interest rates in order to choke off inflation, what the byproduct would also be to slow growth, you could see that interest rates further out on the curve would actually go down. So you might have a re-inversion of the yield curve, which stocks probably wouldn't like, but longer-term bonds would like. So I think you're asking a question about whether bonds deserve a point in the portfolio at a time when, looking backwards, they have hurt you or not helped you as much as they're supposed to. But looking forwards, it might be a good time really to revisit your bond allocation and ask yourself if it's large enough. All of that being said, what could go right? We finish every one of our videos with that question, what could go right? Because generally the financial news is overly negative and it's trying to drive clicks and your eyeballs. As far as the market is concerned, I don't know what could go more right than what's happening now. We've got exploding profitability of the companies that make up the S&P 500, record highs in all the major indices, despite the fact that consumer sentiment, especially at the low end, is effectively as low as it's ever been. And I think the problem for the bottom part of the K, we've talked about the K-shaped economy before, folks that fit into the bottom part of the K are really struggling, and in fact, they're struggling more today than they were a year ago. And they don't care that the S&P and the NASDAQ are at record highs. They're trying to live paycheck to paycheck, and it's more expensive for them to fill up their tank. It's more expensive for them to feed their families. It's more expensive for them to consider buying a new home. So I think that really is, if anything could go right, that really affects the majority of Americans, it's going to have to come from something that's going to positively impact the sentiment for the bottom part of the K. So, and I don't think that can happen without a decline in inflation. I really think that there needs to be some sort of a shock to, whether it's a rate hiking cycle that really just, takes some air out of this tech trade and sort of evens the playing field a little bit, because of course just stocks coming down doesn't help the lower part of the K, but if there were also a reduction in inflation, an improvement in affordability, that would help. So I think this K that has sort of become extended, I think needs to close a little bit for my weak attempt at visualizing what could go right, and I really don't know how that's going to happen. I hope it does, but yeah, we need to see some resolution for what's happening in the Middle East first, and then we also need to see if Kevin Warsh and the rest of the people in charge of making interest rate decisions are willing and able to do something about it.